Some people might think, well, they get rid of this SLR. They'll allow the major Wall Street banks to buy loads of bonds. Yes, they could do that, but what that's going to do as well is that's going to free up a lot of liquidity, which means more currency out there floating around. It's going to be even more inflationary. So I could see it backfiring. Maneko 64, home of alternative economics and contrarian views. Raining quite hard today in Switzerland on Monday. Yes, this video was recorded on Monday, the 7th of July. And I want to talk about the bond market, specifically the U.S. Treasury market. There's been a big reaction to the passage of the big, beautiful bill. There's also some other developments going on geopolitically concerning China, the tariffs, BRICS, that I think are going to have a huge impact on the bond market. But technically as well, if you look at the T-bond futures and the 10-year futures, their prices, it looks like we've broken some key technical levels. We've been in a consolidation for, well, about 2.5, 3 years now. And I think the next leg could be down in price and up in yields. And the interesting thing about what's going on today, Monday, is that the yield curve is steepening, which means that short-term rates are not really moving that much, but the long-term rates are moving higher, which shows that bond investors are worried about the massive amount of deficit spending, the massive amount of fiscal injection into an economy that's already pretty strong, relatively strong. We've got the stock market at all-time highs. We've got the the Warren Buffett indicator of stock market capitalization to GDP at all-time highs. We've got commodities going also through the roof, so to speak. Things like copper, gold, silver breaking out to 12-year highs. And I think investors, they're concerned, especially in the longer end of the bond market. And also with all the talk that the Fed's going to cut rates like 3 times this year. I think the bond vigilantes are worried. And there's also the geopolitical situation that is getting worse in terms of the conflict between Trump, the U.S., and the rest of the world. Trump, I think, posted on Truth Social over the weekend that he was going to punish any country that dealt with BRICS, like put a 10% extra tariff on BRICS. The other thing that shows me a sign of weakness. Many people have dismissed the BRICS, that it's not important. But for Trump to be concerned about BRICS, I think it shows that it is important. And I think this is going to act as incentive to the BRICS nations and the rest of the world that's trying to join BRICS to de-dollarize even more. They're going to say, we can't really depend on doing trade with the U.S. if they're going to be that difficult. And Trump also noted that the BRICS are anti-American. And I think that's wrong. They're not anti-American. They just want to have a bigger say in what goes on in the international financial architecture. And what do I mean by that? Well, they want a reform of the IMF, and the biggest gripe of all other countries, with the exception of the U.S., is that the U.S. is the biggest shareholder in the IMF, and their shareholding gives them a veto power. So anything that the IMF decides can be vetoed by the United States. And the BRICS nations, of course, they're now like 40% of the world's GDP, 45% of the world's population. And the U.S., of course, is not as strong in terms of population nor GDP. So I'm not trying to defend the U.S. nor BRICS nor criticize any country here. We're just looking on this channel. We just look at the facts and the numbers and how it's going to affect not only the BRICS, but also the US, Western Europe, the UK, where I live. Of course, right now I'm in Switzerland for the holidays. But yeah, I think this is serious. And I think the technical picture for bonds, they don't look good, as I said earlier, but also all the fundamental aspects are building up in order to hurt the U.S. Treasury bond market. And why is that? Well, I think the countries that are in BRICS or trying to join BRICS and other countries in the so-called global south, what they're going to do, they're going to try to become less and less dependent on the dollar as a reserve asset for international trade. They're going to try to deal more and more bilaterally. And what do I mean by that? Well, let's say Pakistan and another country like Malaysia, when they're gonna try to use their own currencies. The other thing that we're seeing and is going to continue, because we've seen various surveys from the World Gold Council and other institutions, that central banks around the world are looking to buy more and more gold over this year and the coming year. They've been buying over 1,000 net metric tons a year for the last 3.5 years. And yes, they're abandoning the dollar as not completely, but they're hedging their bets with gold, because gold is not political. Gold cannot impose sanctions on you like the United States and Europe as well, for that matter, have been doing, especially to Russia in the last few years. So all the talk of punishing countries that deal with BRICS, or even countries that are in BRICS, I think is going to have the same impact that freezing Russia's assets had back in 2022. It's going to push foreign sovereign countries more and more into gold as a reserve asset. They're going to look more and more into dealing with other nations without the US dollar. And what that's going to mean is that they're not going to have as much dollars to park in the Treasury market. And that's another reason why US banking regulators and the US Treasury are pushing for the loosening of the statutory leverage ratio, or SLR, for the major US banks, so that they can load up on more treasuries, because Uncle Sam, of course, has got trillions upon trillions to refinance. And if they don't find a captive buyer, rates are going to have to go higher. Yields are going to have to go higher. That's how you attract buyers in a bear market, if you can. Some people might think, well, you know, they get rid of this SLR. They'll allow the major Wall Street banks to buy loads of bonds. Yes, they could do that. But what that's going to do as well is that's going to free up a lot of liquidity, which means more currency out there floating around. It's going to be even more inflationary. So I could see it backfiring. And I guess one thing that they could resort to, especially the Federal Reserve, is to not more QE, because right now they're doing QT. They'll have to stop the QT and then start QE again. But that's going to put a rocket up gold, silver, and all other commodities. So I think we're going into some very interesting times. And not that it's going to be great for everyone. Unfortunately, the people who are going to suffer the most are going to be the poor, the lower quintile of income earning people, or as the British say, the lower classes, the working class. They're going to suffer. The middle class is going to suffer. Maybe the 1%, yeah, they won't suffer because they have the assets and they have enough hard assets as well to protect themselves. The government, of course, they're not going to suffer. They're going to keep operating. And the other thing that's really making things even more interesting is that I think this tariff war, this trade war, could evolve into a kinetic war. And I think that's the way things are going. We're seeing already in Europe as well that major European countries like Germany and even the UK are talking about increasing government spending, fiscal spending. Yes, they've got Russia as a threat, right? I don't buy into that, but that's the narrative they're using. The US is using the narrative that China wants to invade Taiwan, which I think is hogwash. But yeah, they have to convince the domestic voters that that's the right thing to do, that we have a threat. But deep down, the reason they're doing this is that this fiat currency system that's been ballooning and mushrooming since 1971 is coming to a juncture where if they don't keep inflating, it's going to collapse. But the only downside to keeping it going is that our currencies are going to be obliterated. They're already being obliterated. And unfortunately, it's going to hurt the most vulnerable in society, the great majority of the middle class and lower classes. And I think it's not only dangerous in terms of the geopolitical kinetic war situation, but it will create a lot of tension domestically. I mean, there are people talking about civil war in the UK, and that the UK government is using the Russian narrative to prepare for it, only because they can't say that the general public in the UK is getting fed up with all the inflation, with all the taxes, right? And the same thing for the US. It's always the foreigners that's the problem. And yeah, in the UK, they're even talking now about wealth taxes. You know, that's going to come. They want to tax the people who pay the most tax even more. The problem with what's going on is not the wealthy are making people poor. It's the governments and the central banks, the banking sector, who create the inflation. They're the ones who make the general public poor. The reason why the multi-millionaires and the billionaires get richer is because they can protect themselves. So by punishing them, you're going to make it even worse because people are going to leave the UK even more. They're already leaving the UK. It's going to disincentivize the private sector even more. So they always do the wrong things. So as I said, I'm speaking on Monday and you're going to be watching this on Tuesday. But I think the bond markets don't look good. I think it could spill over into the stock market in that we could see the stock market kind of top. Yes, a melt up is still possible, but yeah, there's something brewing in the system right here. And of course, the Fed only meets at the end of the month. We could see them cut rates and start cutting more. I think the Trump administration is really pushing Jay Powell towards rate cuts, and we're seeing some other governors calling for rate cuts. And that doesn't necessarily mean things are great. A lot of times when the Fed starts cutting rates, it means that they're concerned. So watch out. So right now, for example, we saw gold and silver get hit pretty hard earlier today on Monday. But as I speak here, it's like midday New York time, 6 p.m. Swiss time. And gold is still, it's down 0.5% at 33.21, but it traded as low as 32.96, so it's recovered. Spot silver traded as low as 36.14, but we're now at 36.70. So I think gold and silver and commodities are still the place to be in the medium to long term. I see the stock market, the rally we saw earlier today has fizzled out. The Dow futures is basically unchanged. S&P is up about 14 points, and the NASDAQ 100 is up about 60 points. And as I said, the bond market, as I speak here, the 30-year yield, for example, is at 4.92. That's up 6.5 basis points, which isn't a great move, but it's a significant move on a day where things are pretty quiet. But as I said, the curve is steepening because the 2-year yield is up only 1.5 basis point. The 10-year yield, that's up 7 basis points at 4.40. So we need to keep an eye on that. And if you look here at this chart, this is the chart of the T-bond future, which is priced. It's the price of the future, not the yield. So we've broken an important technical level here, or formation, a rising wedge, as you can see, and it looks quite bearish. It's a weekly chart, and as you can see, it's been consolidating for the last 2 years. And prior to that, we had a huge move down, of course, from the top we saw in the bond market. And I think that's the top of the almost 40-year bull market we had in March of 2020. And yes, we've basically been consolidating since the end of 2022. And the key level here in the T-bond future to look for, there are 2 levels. The first one is going to be like 110, and the next one is going to be the low from October 2023, around 107. And I think that could really create a major crisis because, as I've told you many times, the bond markets are much bigger than the stock markets, and especially the Treasury market. That's supposed to be the risk-free rate of return, and those are the rates that are used to calculate discount rates for the value of equities and other corporate bonds as well. So if that starts going up, look out at the stock market and the corporate bond market, at credit. And the other thing it's going to do is a vicious circle. It's going to make the cost of financing the debt even bigger. And with this big, beautiful bill and the huge deficits that it's going to bring, we could see trouble ahead. Yes, this big, beautiful bill is supposed to grow the economy out of its debt. That's still to be seen. That's not going to happen overnight. So there you go. That's what's going on. Yes, and with that, I'm going to wish you all a very good day. And let's keep an eye on these markets. So take care. Bye.